What if I told you every dollar in your pocket is somebody else's IOU, and it didn't exist until someone borrowed? Banks don't pass around your deposit, they create new money when they lend. That's the mechanism, not a myth. That's not a conspiracy theory. That's not fringe economics. That's not some radical interpretation. That's how the monetary system actually works. That's the foundation of modern banking. That's what they teach in economics courses, just never explained clearly enough for most people to understand the implications. And it's the reason you're in debt. The reason your parents were in debt. The reason the government is in debt. The reason everyone is in debt, even when they've done everything right, even when they've worked hard and saved and tried to get ahead. Because the system doesn't work unless everyone is borrowing. The system requires debt to function. Debt isn't a bug. Debt is the feature. Debt is how money gets created in the first place. Have you ever wondered, if everyone in the world paid off all their debts tomorrow, what would happen to the economy? Would we all be free? Would we finally be out from under the weight of obligations and interest payments? The answer is no. The answer is the entire system would collapse, because there would be no money left. Our money is debt. Our economy runs on debt. Growth requires debt. Stability requires debt. Everything requires debt. If you've ever felt like no matter how hard you work, no matter how much you save, you're still running in place, drop a yes in the comments. Because millions of people feel that way. And most of them don't know that the system is designed to make you feel that way. That the treadmill never stops because it can't stop. That getting ahead isn't just hard, it's structurally difficult by design. This is educational content, not financial, economic, or investment advice. Monetary systems are complex and interpretations vary. Always consult qualified professionals before making financial decisions. This video explains mechanisms, not recommendations. Let's start with the basics. The thing you were probably never taught clearly in school. The thing that changes everything once you understand it. When you deposit $1,000 into a bank, what happens to that money? Most people think it sits in a vault, or maybe in a big pool of money that the bank then lends out to borrowers. You put money in, they lend it out, they pay you interest on your deposit, they charge higher interest on their loans, and they profit from the spread. That's not how it works. That model, the intermediary model where banks take deposits and lend them out, is outdated. It's how people think banking works. It's how banking is often taught in introductory courses. But it's not how modern banking actually operates. Here's what really happens. When you deposit money, the bank doesn't lend your cash out of a vault. In modern banking, loans create deposits. If a bank approves a $10,000 car loan, it credits the borrower's account and a matching asset, the loan, appears on the bank's balance sheet. The constraint isn't a fixed 10% reserve, it's capital requirements, liquidity rules, risk limits, and funding costs. That's why banks can expand credit when they have capital and demand for safe, profitable loans, and pull back when those constraints tighten. Someone walks into the bank and applies for a $10,000 car loan. The bank approves it. They don't go to the vault and pull out $10,000. They don't deduct $10,000 from existing deposits. They open a new account or credit an existing account and enter $10,000. New money, created by the loan. Money that didn't exist seconds ago now exists because someone promised to pay it back. That $10,000 is now in circulation. The borrower spends it on a car. The car dealer deposits it in their bank. That bank now has a new deposit, and they can create new loans based on that deposit and their capital position. The cycle continues. What textbooks call a money multiplier is better understood as a feedback loop. New loans create new deposits. Deposits support further lending if banks have capital and borrowers qualify. It's not a conveyor belt. It's a cycle that speeds up in booms and slows in downturns. When you take out a mortgage for $400,000, the bank creates $400,000 in new money. When you take out a student loan for $50,000, that's $50,000 in new money. When a business borrows $1 million to expand, that's $1 million in fresh money entering the economy. All of it created as debt. all of it requiring repayment, all of it generating interest that must be paid back. First time hearing it explained this way? Comment, first time, so I know to make a part 2. Now here's where it gets even more revealing. Every loan adds principal and requires interest, which must be paid from someone's income. In practice, that income often depends on ongoing credit and spending elsewhere. That's why economies lean on continued borrowing. When credit creation stalls, incomes and cash flows shrink, delinquencies rise, and the system strains, not because interest is mathematically impossible, but because cash flows depend on continued circulation and access to credit. You borrow $100,000. The bank creates $100,000 in new money and credits your account. But you owe $100,000 plus interest. Let's say 5% annually over 30 years. You don't just owe $100,000. You owe something like $193,000 total by the time you've made all the payments. The bank created $100,000. But the $93,000 in interest must come from economic activity, from your income, which depends on spending and lending happening elsewhere in the economy. When lending slows, when credit contracts, there's less economic activity generating the income needed to service existing debts. That's a recession. That's a financial crisis. Not a failure of the system, but the system operating exactly as it must when debt creation slows. The system is designed so that it requires ongoing credit expansion just to keep functioning smoothly. If everyone tried to pay off their debt simultaneously and stop borrowing, economic activity would contract sharply. There wouldn't be enough circulation to service debts because income generation depends on continued spending and lending. That's not a flaw. That's not an oversight. That's the structure. That's how debt-based money works. Growth isn't optional. Expansion isn't optional. Credit availability matters constantly, not just occasionally. They call it economic growth. What they often mean is credit growth. GDP goes up when borrowing goes up. GDP goes down when borrowing slows. The economy is healthy when people and businesses and governments are taking on credit. The economy is in trouble when credit creation slows. Have you felt credit tightening in your life? Cards, mortgage, car loan approval? Type tight if yes. You're not imagining it. The system really does depend on continued borrowing. Now think about what that means for you personally, for your life, for your choices, for your sense that no matter how hard you work, it's never quite enough. You work for dollars. You trade your time, your labor, your skills, your energy for dollars. But those dollars exist because someone, somewhere, borrowed them into existence and promised to pay them back. You save dollars. You try to build a cushion, a safety net, a retirement fund. But inflation slowly erodes the purchasing power of those saved dollars. Not randomly, not accidentally, but systematically, because the system expands credit over time, which expands the money supply, which tends to push prices higher. More money chasing roughly the same goods means prices adjust upward. Your savings buy less. You try to get ahead. You work overtime. You get a degree to increase your earning potential. You invest. You save. You do everything you're told to do. But the rules themselves are designed around credit expansion, asset appreciation, and inflation, not around rewarding pure saving of currency. Every policy decision, every interest rate change, every stimulus program, every quantitative easing, it's all designed to manage credit growth, to keep lending happening, to keep the system from contracting. They tell you to build wealth, to save, to invest, to get ahead. And you should, because within the system, those are the best strategies available. But understand what you're doing. You're building wealth in a system where money itself is created through lending, where the foundation is credit, where the entire structure requires ongoing expansion. If that makes you clear-eyed and strategic rather than hopeless, good. Not helpless, frustrated. but understanding frustrated. The kind that comes from seeing how things actually work. The kind that motivates you to navigate consciously instead of being swept along unconsciously. Because once you understand how money is actually created, once you see that it's debt-based, that it requires lending, that servicing interest depends on ongoing economic activity fueled by continued credit, you realize something fundamental. You're not failing at money. You're operating inside a design that rewards owners of appreciating assets and pressures wage earners. Once you see the design, you can choose tools that work with it instead of against it. Let's zoom out and look at how this works at the highest levels. Because it's not just you. It's not just your mortgage or your student loans or your credit cards. It's governments. It's entire economies. The mechanism operates at every scale. Governments need money to operate, to pay salaries, to fund militaries, to build infrastructure, to provide services. They get that money primarily through taxes. But taxes are rarely enough. Expenses typically exceed revenue. So, governments borrow. Here's how it works. Governments spend by issuing treasury securities. Banks and investors buy them. The central bank can later purchase those bonds in the market, creating new bank reserves in the process. Quantitative easing. Net effect. Public debt becomes safe assets for the banking system, and spending injects money into the economy, while taxpayers ultimately service interest costs. Who buys those bonds? Investors, yes. Pension funds and foreign governments and individuals. But also banks, commercial banks, and central banks. When the central bank buys government bonds, it creates new reserves in the banking system. When commercial banks hold government bonds, they're holding interest-bearing assets backed by the government's ability to tax and borrow. The government spends that money on defense contracts, on social security payments, on highway construction, on whatever. That money enters circulation. It becomes part of the economy. Now the government owes that money back, with interest. Where does the money to pay that interest come from? Taxes. Your taxes. You work, you earn dollars that were created through lending somewhere in the system, and you pay a portion of those dollars in taxes, which go to service government debt, which helps sustain the debt-based monetary system. It's a closed loop. Credit creates money. Money circulates. You work to earn it. You pay taxes. Those taxes service public debt, and the cycle continues. Paying down public debt at scale would withdraw money from the system unless monetary policy offset it. That's why, in practice, advanced economies rarely run sustained net paydowns. They manage debt relative to GDP rather than trying to eliminate it outright. National debt isn't a burden that future generations will pay off someday in the traditional sense. Government debt is part of the financial architecture. It provides safe assets, enables monetary operations, and represents claims on future tax revenue. That's why politicians from both parties, despite rhetoric about fiscal responsibility, don't actually pay down the debt significantly. The system doesn't reward it. Reducing debt means potentially contracting money and credit, which means recession, which means unemployment and business failures and political consequences. So they borrow more. They issue more bonds, credit and debt continue expanding, and the money supply grows, and inflation happens over time, and you feel it in your grocery bill and your rent and your insurance premiums. But you don't necessarily connect it to monetary structure because no one explained how the system actually works. Now let's talk about what this means in practical terms. How this abstract monetary theory shows up in your daily life in concrete ways. You want to buy a house. Houses in your area cost $500,000. You don't have $500,000. Almost no one does. So you take out a mortgage. The bank creates $500,000 through the lending process. The seller receives payment, and you now owe $500,000 plus decades of interest. That $500,000 didn't exist in the same form before you signed the mortgage papers. Your future labor, decades of it, was monetized through credit and turned into present purchasing power. You traded future income for present ownership. But here's the thing. If everyone stopped taking out mortgages, the housing market would face severe stress. Not because houses aren't valuable or useful, but because there wouldn't be sufficient credit availability to support current price levels. Home prices are partly sustained by the availability of mortgage credit, by the creation of money through lending. The same is true for cars, for education, for business equipment, for much that's purchased with borrowed money. Prices are partly a function of how much credit is available. When credit is easy and banks are expanding lending, prices tend to rise. When credit tightens and less money is being created through loans, prices face downward pressure. This is why central banks like the Federal Reserve manipulate interest rates. Central banks move rates to balance inflation and employment, and by doing so, they influence the pace of credit creation and money growth. Lower rates make borrowing cheaper, which encourages more borrowing, which creates more money through lending, which expands economic activity. Higher rates make borrowing more expensive, which discourages borrowing, which slows credit creation, which moderates economic activity and inflationary pressure. They're not manipulating the cost of borrowing for moral reasons. They're managing the pace of credit creation. Because in a debt-based monetary system, managing credit is managing money. When they say the Fed is fighting inflation, they mean the Fed is raising interest rates to slow borrowing to moderate money creation to reduce inflationary pressure. When they say the Fed is stimulating the economy, they mean the Fed is lowering rates to encourage borrowing to speed credit creation to expand economic activity. You're caught in the middle. When rates are low, you're encouraged to borrow, to buy a house, to buy a car, to expand your business, to use credit. But when rates rise, servicing that debt becomes more expensive. Your mortgage payment takes more of your income. Your business struggles with higher financing costs. The system encourages you to borrow when it wants expansion, then makes that debt more expensive when it wants to slow growth. And you didn't create the system. You didn't choose the rules, but you have to navigate them or opt out of major parts of modern economic life. Here's the deeper psychological and philosophical insight. The system makes you believe that money is intrinsically real, that it's valuable in itself, that accumulating it is the ultimate goal. But money is not real in the sense that a house is real, or food is real, or land is real. Money is an agreement, a collective system, a ledger entry, a claim on future goods and services. It only functions because participants agree to use it and accept it. And in our current system, that agreement is based substantially on credit and debt. Your dollar has value partly because people need dollars to service debts and participate in the economy. That creates demand for dollars. That demand is what gives dollars value and utility. If all debt were suddenly resolved, the demand dynamics for currency would shift dramatically. The system would face massive disruption. This is a key insight. Money functions partly because people are in debt and need it to service obligations and participate economically. Credit and debt create ongoing demand for the currency. So the system doesn't want everyone completely out of debt. The system needs ongoing borrowing, not unsustainable overleveraging that causes defaults. That's bad for the system, but ongoing manageable credit use that keeps money circulating and the economy functioning. Your mortgage, your student loans, your car payment, these aren't just personal financial obligations. They're structural features of how money circulates and maintains value in a credit-based system. Once you see that, once you really understand it, you stop treating money like something sacred or mysterious. You stop worshiping it. You stop feeling existential guilt about credit in the abstract. Not all debt is beneficial. Destructive debt damages your finances. But credit itself isn't morally wrong in a system where credit creation is how money enters the economy. You start seeing money for what it actually is: a tool, a technology, a claim, a current in a system designed to facilitate exchange and economic activity. And when you stop worshiping money, when you stop treating it as the goal rather than the tool, you start using it strategically instead of it using you. So what do you do with this knowledge? How do you navigate a system that works this way? Educational only. Credit and investing carry risk. Tax and legal outcomes vary. Talk to a licensed pro before using leverage or changing your debt strategy. First, understand that you can't opt out completely. Not realistically. Not if you want to participate in modern economic life. You're going to use dollars. You're going to have bank accounts. You're probably going to use credit at some point. That's not failure. That's reality. But you can navigate consciously instead of unconsciously. You can understand the dynamics and use them strategically instead of being used by them. Use credit strategically, not desperately. Credit is a tool. In a system where money is created through lending and inflation tends to erode currency value over time, borrowing at low interest rates to acquire appreciating assets can be advantageous. Borrowing at high rates for immediate consumption is usually destructive. A mortgage at 3% to buy real estate that may appreciate can be strategic. After inflation and tax benefits, the real cost of that borrowing may be minimal or negative. You're using credit to acquire an asset that may protect against inflation. Credit card debt at 20% to buy things you consume immediately means you're paying significantly in real terms for temporary satisfaction. That's using credit against yourself. Own assets that may appreciate or generate income. In a system where credit expands over time and inflation is a tendency, holding assets that can rise in value or produce income offers some protection. Real estate, businesses, stocks representing ownership in companies, things with economic utility that can adjust to currency changes. Holding large amounts of idle cash means accepting gradual purchasing power erosion by design. Not because you're doing something wrong, but because the system tends toward monetary expansion and you're holding the thing being expanded. Understand leverage on your terms. Sophisticated participants use the system strategically. They borrow at favorable rates against appreciating assets. They use credit to amplify their ability to acquire income-producing property. They understand that in an inflationary environment, fixed-rate debt becomes easier to service over time in real terms, while assets may appreciate. You can't do this at institutional scale, but you can understand the principle. Strategic credit on assets with economic value is leverage. Desperate debt on depreciating consumption is usually a trap. Avoid debt on rapidly depreciating assets when possible. Cars lose value quickly. Electronics become outdated. Consumables are used up. Borrowing to buy depreciating things means you're paying interest on something worth less every day. If you need the item and borrowing is the only realistic option, fine, but understand you're taking a financial hit. Do it consciously, not reflexively. Don't mistake income for wealth. You can have high income and limited wealth if you're spending it all. You can have moderate income and build wealth if you're using it to acquire assets with lasting value. Income is a flow. Wealth is ownership. In a credit-based system that tends to favor asset appreciation over wage growth, building wealth through ownership matters. Recognize that financial education is often deliberately unclear. The system benefits when most people don't fully understand how money is created, when they don't know that credit creates deposits, when they don't think strategically about leverage and inflation and asset ownership. The system prefers people working hard, earning wages that adjust slowly, saving in currency that erodes, borrowing for consumption at high rates, and staying on the treadmill without fully understanding the rules. Understanding breaks that pattern. Let's talk about what this means for society broadly. Because it's not just personal finance. This system has consequences for how economies operate, how power is distributed, how wealth concentrates. In a debt-based monetary system, those closest to credit creation and asset markets tend to have structural advantages. Banks create money through lending. Large institutions access credit at favorable rates. Wealthy individuals can borrow against appreciating assets. Governments borrow at sovereign rates and spend new money into the economy. The first recipients, Contractors, employees, program beneficiaries receive money while it still has full purchasing power relative to what comes later. By the time that money circulates through the economy to wages for regular workers, some price adjustments may have begun. Inflation isn't felt uniformly or instantly, but tends to benefit those who receive new money early or hold appreciating assets. This distributional effect, often called the Cantillon effect, doesn't hit everyone equally or identically every cycle, but over time it tends to benefit those closest to new credit and asset markets more than wage-only households. Asset owners tend to do well in inflationary periods, while wage earners face pressure. Assets are positioned near where credit is deployed: real estate financed by mortgages, businesses funded by loans, stocks bought with leverage. Wages adjust more slowly and are further from money creation. It's a structural pattern, from workers to owners, from wage earners to asset holders, from people who earn money through time and labor to people who own property that appreciates when credit expands. This isn't conspiracy. This is mechanism operating openly. Most people just don't understand the mechanism clearly enough to see how it distributes benefits and costs unevenly. Inequality doesn't grow primarily because of differences in work ethic or talent. It grows partly because the monetary system itself distributes the benefits of credit expansion and inflation unequally. Those who own appreciating assets and have access to favorable credit benefit structurally. Those who rely primarily on wages and hold currency lose ground structurally. Now, let's address the big question. If this system has these characteristics, why hasn't it changed or collapsed? Because it works for the participants who have the most influence over it. It works for banks who profit from lending. It works for governments who can spend beyond tax revenue without immediate political consequences. It works for asset owners who see wealth grow through credit expansion and inflation. It works for the financial sector that intermediates credit. It works less well for wage-only earners and currency savers. But wage earners and savers don't control monetary policy. They don't sit on central bank boards. They don't write banking regulations. They don't fund political campaigns at levels that shape major policy. The participants who benefit most from the system are positioned to maintain it. That's not conspiracy. That's incentives. That's how systems persist. And the system can continue as long as confidence and functionality hold. As long as people accept dollars in exchange. As long as credit keeps expanding enough to sustain economic activity. As long as defaults stay manageable. The system runs on confidence and participation. Could it face crisis? Yes. If confidence breaks, if credit contracts too sharply, if inflation runs out of control and people lose trust, if debt levels become unsustainable relative to income. These are real risks. But crisis isn't inevitable or imminent. The system is resilient partly because it's flexible. Central banks can adjust. Policies can change. Rules can be rewritten when necessary to prevent catastrophe. What's more certain is that the system will continue operating roughly this way until it evolves or changes. And whether it continues for decades or transforms sooner, understanding how it works gives you better tools to navigate it while it exists. Here's what you need to understand on a practical level. You're participating in a system with specific dynamics. You didn't create those dynamics. You might not prefer them, but refusing to understand them doesn't make you righteous. It just makes you less effective. The dynamics are: money is created through lending. Credit creates deposits. The system favors ongoing borrowing. Inflation is a long-term tendency. Assets tend to appreciate faster than wages adjust. Leverage is powerful when used well, and dangerous when used badly. Proximity to credit and assets is structural advantage. Those are the dynamics. Complain about them if you want. Work to change them if you can. But in the meantime, navigate with open eyes. That means think in real terms, not nominal terms. A 5% raise sounds good until you realize inflation was 6%. You didn't get richer. You got poorer in purchasing power. Measure in what money can actually buy, not just the number. Understand that passive saving in currency alone may not be enough. Currency in a savings account earning 1% while inflation runs 4% means you're losing purchasing power. Assets with economic value that can adjust to inflation offer different dynamics. The system tends to reward ownership over pure currency hoarding. Use favorable credit to acquire economic value when appropriate. When rates are low, when you have stable income, when you understand what you're acquiring, strategic credit is leverage. It's using the system's credit creation for your benefit instead of just working to earn money after it's been created. Avoid expensive debt on consumption that evaporates. High-interest credit cards, payday loans, consumer financing at predatory rates, these work against you. They extract your future earnings for present consumption that provides no lasting value. Build multiple income streams if possible. A single wage is vulnerable. Ownership generates potential passive income. Multiple streams mean you're less trapped on the wage treadmill alone. Invest in yourself. Skills, knowledge, credentials that increase your earning power are assets that can't be inflated away easily. They're portable. In a system that erodes financial assets through inflation, human capital retains value. Most importantly, stop feeling existential guilt about navigating strategically. You didn't create a system where money is credit-based. You didn't design an economy that requires ongoing lending. You didn't build a structure that tends to favor asset owners over wage earners. You were born into it. Using the tools available, credit, leverage, asset ownership, strategic borrowing, isn't cheating. It's understanding how the game works and playing accordingly. The guilt you might feel about using credit, about not just working harder and saving more in currency, that guilt can be a form of control. It keeps you from using available tools. It keeps you on the treadmill thinking that if you just work harder, you'll escape. But the treadmill is designed so you don't escape by running faster alone. You understand the design and navigate strategically. Let's be clear. We're not saying don't work hard. We're not saying all debt is good. We're not saying the system is perfect or that you should just accept it uncritically. We're saying, understand how it actually works so you can navigate consciously. Know that money is created through lending. Know that credit creates deposits. Know that inflation is a long-term tendency. Know that assets tend to appreciate while currency erodes. Know that leverage is powerful when used correctly and destructive when used badly. And know that the dynamics favor certain strategies and positions. If you don't understand what those are, you're navigating without a map. You don't have to like the system. You can work to change it. You can advocate for different structures, different rules, different monetary arrangements. But while you're living in this system, you might as well understand how it works and use that understanding. Because financial struggle isn't always about personal failure. Sometimes it's about systemic design that most people don't fully understand. And when you understand the design, you stop blaming yourself for struggling in a game whose rules you were never taught. Here's the final piece. None of this is permanent. Monetary systems evolve, rules change, structures get reformed or collapse and get rebuilt. Previous systems, gold standards, commodity money, various currency arrangements, all had their time and gave way to something else. Each had its own logic, its own benefits, its own problems. This system will eventually change too, maybe gradually through reform and evolution, maybe through crisis and transformation, maybe through technology, digital currencies, new forms of money that operate on different principles. But for now, this is the system. And understanding it, really understanding it, not just surface-level stories but actual mechanisms, is valuable. It's the ability to see clearly instead of through fog, to make strategic decisions instead of reactive ones, to use tools instead of being used by them, to build economic security instead of just earning income, to navigate instead of just survive. That's what real financial education means. Not budgeting tips, not savings hacks, not investment products marketed to you, but understanding the system you're operating in, the actual rules, the real mechanisms, the structural dynamics. Once you see that money is created through lending, that credit creates deposits, that the system requires ongoing borrowing, that inflation is structural tendency, that assets tend to outpace wages, everything else makes more sense. You stop feeling confused about why working hard isn't enough. You understand why the treadmill never stops. You see why strategies that worked for previous generations don't work identically now. You get why the standard advice, just save more, just work harder, isn't sufficient alone. Because the challenge isn't just you. The challenge is navigating a system with specific dynamics, while most people don't understand those dynamics clearly. Understanding the real game, the credit money game, the inflation tendency, the asset appreciation dynamic, gives you different strategies. Better strategies. Strategies that work with the system's design instead of against it unknowingly. Want to follow up on how to position yourself as a regular person in a debt-based money system? Comment, "Play smart," and I'll know there's interest. Because when enough people understand how money actually works, when the fog clears, when the mechanisms become clearer, when more people see the structure, conversations change. You can't unknow this. You can't go back to thinking money is just neutral, that credit is just personal irresponsibility, that inflation is just prices randomly rising, that the system rewards hard work alone regardless of strategy. Now you know. Money is created through lending. Credit creates deposits. The system depends on ongoing borrowing. Inflation is a tendency embedded in the structure. Assets tend to appreciate while currency erodes. Leverage is power when used wisely. Understanding the dynamics is advantage. Those are the actual dynamics, not the simplified stories, the mechanisms that actually govern how the system functions. And understanding those dynamics doesn't guarantee success, but it means you're navigating the system you're actually in, not the system you wish existed or were told exists. It means you stop blaming yourself for systemic patterns. Stop feeling guilt about strategic choices. Stop treating money as sacred and start using it as a tool. Stop being used by credit and start potentially using credit strategically. Stop working only for currency and start thinking about how to make money work for you. Because in a system where money is created as debt, where ongoing borrowing sustains economic activity, where inflation tends to erode currency, where assets tend to outpace wages, understanding is valuable. Not easy wealth, not guaranteed success, but clarity. The ability to see how the game actually works and navigate accordingly. They built a system that runs substantially on credit and debt. They benefit when you don't fully understand it. When you feel confused about borrowing, scared of leverage, faithful only to currency saving, trusting that hard work alone will automatically save you. But now you see more clearly, and you can't unsee it. The banking story. That money is neutral, that it exists independently of debt, that it's primarily created by governments printing, doesn't hold up to scrutiny. The reality, that money is created largely through lending by banks, that credit creates deposits, that the system requires ongoing borrowing, is clearer. And with that clarity comes better navigation ability, not infinite power, not effortless wealth, but the power to see the structure and move through it more consciously. That's what they never wanted widely distributed, and now you have it.